Hi, I'm Tom Mihawk, and this is part of a personal finance course. This chapter is called Investment Fundamentals. This is the chapter that introduces the notion of investing. It's after we've done insurance. Earlier in the semester, in the course, we do taxes and budgets and career aspects of personal finance, and this is the first one that talks about investing. Why do we invest? Let's take a look at this great slide. This shows that if we take what we earn and spend only part of it, spending is in the blue part of the bar, and the green is what we save. And take what we save and invest it. And invested over time due to compounding, a little can become a lot. And this is a great way to think of it. Start early, invest regularly, spend less than you make, and invest well. What does it mean investing? Investing means to be able to keep up with the cost of milk and eggs. And I don't mean that literally, I mean that figuratively. It just means that if you keep your money under your mattress, eventually you won't be able to afford the milk and the eggs. And so we need to do something more with our money. We need it to work for us when we're not working and when we are working. And so we need to invest. The prices of goods and services in healthy economies go up over time. In poor economies, they go up astronomically, too much, or in poorly functioning economies, they go down. What you'd like to see in a healthy economy is for prices to be going up gradually. And in most economies, they do, such that in 10 years' time, your purchasing power is halved. Remember the rule of 72 at 7.2% per year. In 10 years, your money is halved in value. So implement a plan for your money to grow over time by purchasing things that increase in value over time, like stocks. Lend to people that pay you for doing so, bonds. Let people use your money short term who will pay you for doing so, like banks. So preparing to invest and getting started. Preliminarily, have enough financial stability. Are you paying your bills on time? Are you saving systematically? Are you building some net assets? Build an emergency fund, critical, 3 months, 6 months, 9 months. I'm not going to argue about the exact amount of time, but you need an amount of money that covers your monthly expenses so that if you move, if you lose your job, if you join a partner across country and need 3-4 months to get a new job, if you lose your job, you need time to find a new one. An emergency fund will help cover your expenses during that time that you don't have income. And optimally, you'd have no or low debt. The next best would be serviceable amount of debt that your income allows you to handle. Which gets to the next point, which is getting started. Some people will get started after they've set up financial stability, an emergency fund, and knowing they have no or low debt. Others will want to get started investing maybe sooner if they can handle it. So learn about investing, add to your knowledge regularly, stay informed. The world of investing changes constantly. There are basics to learn, and that's what this course is for and what you take this course to learn about. But what people discuss in blogs and podcasts, what you read about and hear about on the news, are things that are changing constantly in investing. Invest early in life and often and as much as you can. That is how you will build net worth over time. Understand investing time frames, the impact your age and life category, being single, married, having young children, retired. Understand risk and return, the return behavior of standard asset classes, and diversification. And by the way, we're going to talk about all those things in these slides. And start with an amount that allows you to have current financial stability while planning for the future. You don't have to start with an amount that disables you, that pushes you backwards. Start with an amount that allows you to plan for the future, and then put as much as you can. This is a chart that I use often in the classroom, and it mixes a number of things, but I've entitled it Risk, Return, Volatility, and Time. Risk and return are related, such that in general, a high returning security or asset is going to be riskier in general. Now, if you find a riskier one, it may not necessarily have a higher return, but a higher returning asset is likely to be riskier. And by risk, we would describe it by its volatility, how much it moves up and down over time. And then the time frame, short time frame, medium time frame, longer time frame. Now, let's see if I can get this to work. But I'll say to students, which of the three securities you see in this chart would you like to have, A, B, or C? Some will say, well, I want A. I want A because it's steady the whole time, and I like that. Another student will say, no, I want C. I want the highest return, and that's what's best. And then I point out, well, if you want C, what if you need it at this time, in the short term, or here, in the midterm? Now, when you're here, this is great, right? But if you need it in the short term or the midterm, you could be in trouble. That's why having a long-term time frame for this asset C is most important. You need to have a long-term time frame, and this is similar to what you would look at in your 401k plan, your retirement assets, right? Long-term time frame. Now, this C security is exaggerated, but its volatility is not unlike what you might see in a high-earning security, best for the longer term. A is best for the short term. If you're going to get married or go to law school or grad school or need money to buy a car in a year, 2 or 3, well, A is a good choice. C is a good choice for your retirement, for long-term investing. And B is a mixture that you might create. You might find it by itself, or you might create it mixing A and C together in a portfolio. Let's take a look at what real securities look like. On the left chart, notice that since 1802 at the y-axis and 2000, it looks like maybe 6. Notice that stocks have gone from $1 to $705,000, bonds to $1,778, bills, which are shorter term bonds, $281, etc. The point is that these are the actual returns of these securities, stocks, bonds, and bills. Notice also in the right chart the holding period return. So for 1-year periods, the annual return, this is for the Standard & Poor's 500 index between 1996 and 2011. Notice that in 1 year it returned as high as 54% and as low as 43%. This is the leftmost bar. For 3-year periods, as high as 31 and as low as 27. And notice that when you get to 10-year periods, you've only lost 1.4%, is the lowest that the return was for the 10-year period, which is outstanding. And for 20-year periods, and my picture unfortunately covers it, but in the far right, 20-year periods, there was never a losing time frame. The lowest return was 3%. This is why owning securities, investing for the long term, is such a valuable strategy, because the longer you own, the more volatility plays to your benefit. You don't get stuck needing money in the short term when the security's gone down in value. So let's look at some sources of risk. Business risk, the possibility the business will fail, products won't be successful, leadership makes poor decisions, company leadership makes poor decisions, consumer taste change. I asked in my class once, how many had an iPhone? Almost every hand went up. How many owned at one point an iPod or an iPad? Almost every hand went up. How many owned the iWatch? Not so many hands went up. Now this was a few years ago. Now I would say, I don't know, maybe a third or half of the hands would go up for the iWatch. But the point is that what if that was a bad choice of a product? I know that it has more product possibilities than it had, more future possibilities than it had when it was introduced. But the point is, if management makes a bad decision with products or services or executes poorly, it could result in the value of the business going down. Other risks, interest rate risk. When rates go up, it's more expensive for companies to fund their needs with debt. And debt securities for investors become less valuable. When interest rates go up, prices of debt securities go down. And we'll talk about that in the bond chapter. But interest rates up, debt securities prices down. Market risk. is when stocks prices fall due to market action, global investor sentiment. People are nervous. As this is being recorded, we're in the middle of the coronavirus, and the stock market is down to bear market territory because of concerns of different countries' reactions to the coronavirus. Other ones, inflation risk. When inflation increases, it's more expensive to purchase products and services. This is back to my first slide, or second or third. When you put your money under your mattress, if inflation goes up, it's more harmful for you because your money is less valuable in the future. And currency exchange risk. When local currency strengthens, it's harder or more expensive for foreign markets to buy your products, and so it's harder to ship them abroad when you have a strong local currency. So these are some sources of risk. This is the end of the first segment. There'll be 3 segments in this investment fundamentals chapter, and we'll see you in the next one in just a moment.